In the U.S., personal loans and credit cards are two popular options for borrowing money. Both can help cover expenses, manage emergencies, or pay for big purchases, but they work in very different ways. Deciding which one is better depends on your financial needs, repayment ability, and goals. While personal loans offer fixed payments and lower rates, credit cards give you flexibility and rewards, but they also come with risks. In this video, we'll explore the differences between personal loans and credit cards in simple terms, so you can choose the option that works best for your situation and lifestyle. In this video, we will talk about personal loan versus credit card. What's better in the US? So before we get started, make sure to hit the like button and also subscribe to our channel. 1. How personal loans work. A personal loan is a type of installment loan. You borrow a fixed amount of money and repay it in equal monthly payments over a set period, usually between 1 to 7 years. The interest rate is often fixed, meaning your payment stays the same every month. These loans can be used for almost anything: paying off debt, covering medical bills, or funding home repairs. Once approved, you receive a lump sum up front. You then start repaying right away, based on the agreed terms. Because of their structure, personal loans are easy to budget for. You know exactly how much you owe each month, which helps with planning and discipline. 2. How credit cards work. Credit cards are a form of revolving credit, meaning you can borrow up to a certain limit, repay it, and borrow again. There's no set repayment term, and you're only required to make a minimum payment each month, although this can lead to interest building up quickly. Credit cards are great for everyday spending, online purchases, or emergencies. Many offer rewards, cashback, or travel points, making them popular for regular use. However, interest rates on credit cards are often much higher than personal loans. If not managed properly, credit card debt can grow quickly and become difficult to pay off. It requires strong discipline to avoid overspending and falling into debt traps. 3. Interest rates comparison. Personal loans usually have lower interest rates than credit cards. As of 2025, the average personal loan interest rate in the U.S. is around 11%, while credit card APRs can range from 20% to 30% or even higher, especially for people with bad credit. If you're planning to carry a balance over time, a personal loan will likely cost less in interest. That's why many people use personal loans to consolidate and pay off high-interest credit card debt. The exact rate you receive depends on your credit score, income, and lender policies. But in general, personal loans are more affordable for long-term borrowing. 4. Repayment terms and flexibility. Personal loans come with fixed repayment schedules. You borrow a lump sum and make equal monthly payments for a set time. This structure gives you clarity and helps with financial planning. Credit cards offer more flexibility in repayment. You can choose how much to pay back each month, as long as you meet the minimum. This can help during tight months, but it often leads to debt growing if you're not paying off the full balance. If you need structure and a clear payoff date, personal loans are better. If you need ongoing access to credit and can pay in full each month, credit cards work well. 5. Loan amounts and credit limits. With personal loans, you can often borrow larger amounts, sometimes up to $50,000 or more, depending on your credit. This makes them ideal for big expenses like weddings, home improvements, or major debt consolidation. Credit card limits are typically lower unless you have excellent credit. Limits usually range from $1,000 to $25,000, and they can change based on your spending habits and payment history. If you need a large one-time sum, a personal loan is the better choice. For smaller, everyday expenses, a credit card may offer enough room, especially if you're earning rewards while using it. 6. Approval process and speed. Getting approved for a personal loan usually requires more paperwork. Lenders will check your credit score, income, employment history, and sometimes ask for documents like pay stubs or tax returns. Approval can take a few days. Credit cards tend to have a faster application process. Many people get instant decisions online, especially if applying through their bank or credit union. The credit requirements are also flexible depending on the card. If you need funds urgently, a credit card might be quicker. But if you qualify and can wait a few days, a personal loan may give you better terms and lower rates. 7. Credit score impact. Both personal loans and credit cards affect your credit score, but in different ways. A personal loan can help your score by improving your credit mix and showing on-time payments, but it also adds a hard inquiry and new debt at once. Credit cards impact your score through utilization rate, how much of your available limit you're using. If you max out your card or carry a high balance, your score may drop. Paying your balance in full helps improve your score over time. Used responsibly, both can boost your credit, but misuse, like missed payments or high balances, can hurt it quickly. 8. Best use cases for each option. Use a personal loan when you have a big one-time expense that you want to pay off steadily, like a car repair, medical bill, or credit card debt. It's also great for consolidating multiple debts into one fixed payment. Use a credit card for everyday purchases, travel bookings, or emergencies, where you plan to pay off the balance quickly. Cards are also useful for building credit, earning rewards, and gaining fraud protection. Choosing the right option depends on how much you need, how quickly you can repay it, and what features, like rewards or structure, matter most to you. 9. Fees and hidden costs. Personal loans may come with origination fees, usually 1 to 6% of the loan amount, prepayment penalties, or late fees. Always read the loan agreement carefully to understand total costs. Credit cards may charge annual fees, cash advance fees, late fees, and foreign transaction charges. If you miss a payment, you might also face penalty APRs, which are very high interest rates triggered by a single late payment. Always compare offers side by side and ask lenders about total cost, not just interest rates. Understanding the full picture helps you avoid surprises and choose the most affordable option. 10. Long-term financial impact. Personal loans can offer peace of mind with a clear end date. Once the loan is paid off, you're done. This can improve your credit, reduce stress, and help you move on financially. Credit cards, if not used carefully, can lead to long-term debt cycles. Many people carry balances for years, paying more in interest than the original purchase amount. If your goal is to get out of debt or manage money better, personal loans give you a fixed path. If you want flexibility and can pay responsibly, credit cards can offer value, but only if used with care. When choosing between a personal loan and a credit card, there's no one-size-fits-all answer. Personal loans offer structure, lower interest, and predictable payments, ideal for big purchases or paying off debt. Credit cards provide flexibility, rewards, and quick access to funds, but they come with higher interest and greater risk if misused. Understanding how each option works, including fees, repayment terms, and credit impact, helps you make smarter financial choices. Consider your spending habits, income, and goals before deciding. With the right approach, both tools can support your financial health, but it's how you use them that matters most. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.